Good afternoon, everybody. I'm Doug Silverman, the president of the Arab Gulf States Institute, and it is my great pleasure to welcome everybody here today to have a really needed discussion of the Saudi economy. I just want here to welcome you and say thank you for coming. I'm really looking forward to our panel. We'll be led by our senior fellow, Tim Callen. I was going to say Callen. We're going to base this on the IMF Article 4 report on Saudi Arabia. And I think that there are a lot of things, given the turbulence in the politics of the region, the changes in the Saudi economy, and a lot of questions now about whether or not the very, very ambitious development goals that were set out by the Crown Prince and the government can be achieved, at least on the schedules that they are. Not to mention, what does oil revenue look like, and how is Saudi Arabia going to have to deal with, if not budget shortfalls, at least continuing to finance these very big projects. So with that, I want to turn it over to Tim and let him introduce our exceptional panelists and start the discussion.
Very good. Thank you, Ambassador, and let me add my welcome to those in the room and joining us online. It's really nice to see such a big group in the room, so thank you for coming. So we have, I think, a great topic and a great panel today. There's a lot of interest clearly in the Saudi economy and the reforms, and I'm very pleased to welcome both Amine and Callen to AGSIW to discuss the latest IMF report on Saudi, but also broader reforms and views on the economy. I don't think either Amine or Callen need much introduction, and I have a long list of sort of accomplishments they both have. But let me just say Amine is the IMF mission chief to Saudi Arabia, so is responsible for the report that was published a week or so ago. He's been the mission chief since January 2022, so clearly has a very deep knowledge of the Saudi economy. Many other things he's done at the IMF, which I won't go through now, but welcome, Amine. And Callen, again, I think needs no introduction. Sort of certainly in Washington and more broadly, she's hugely well known for her analysis of the Gulf, the Middle East, energy market issues. She's currently a senior research scholar at Columbia University Center on Global Energy Policy, has been working at the Middle East Institute, also previously at the American Enterprise Institute and here at the Arab Gulf States Institute. So welcome, Callen. How we're going to do this is Amine's going to give us a sort of roughly 10-minute summary of the key points in the IMF report. Callen's then going to offer her views, both the report and I think more broadly. We'll then go to Q&A, both from within the room and online. So if I could ask particularly those joining us online, if you can put your questions in the Q&A as soon as possible, and we'll try to get to as many as possible. I guess within the room, just raise your hand and I'll try to get to as many as possible. So let me stop there and let's use the time as much as we can to discuss Saudi Arabia. So let me hand over to Amine and ask him for a summary of the IMF report.
Thank you very much, Tim, and thank you all for being here. Very pleased to be back at the Arab Gulf State Institute in Washington. This time I got it right. And for what could almost be an annual event, Tim was kindly introduced me. He forgot to say that I actually replaced him as Saudi Arabia IMF mission chief. Our report is out, so I will be very brief on some of our findings so that we can leave a lot to the discussion. Let's first start with the developments. Saudi economy continues to grow strongly, particularly on non-oil growth. Last year in 2023, it was 3.8%. The non-oil real private sector investment growth still kept up and propped up domestic demand along with consumption. And we have that for some of the implementation of the projects. It's at a more moderate pace than what we have seen in 2022, when we saw non-oil real private sector investment going by 35%, but it's still quite robust. So the headline number could be that overall growth is declining by 0.8%, but that's really the hydrocarbon sector. The non-hydrocarbon sector is still growing quite robustly, one with the implementation of the Vision program, and we've seen that as part of the investment materializing. Inflation is quite contained. If we were to look at some of the numbers, the latest in July is 1.5%. We were, if you remember last year, we were concerned about if all those projects come together, all those input costs, and all the demand for the input, we would expect some increase in inflation. We've seen wholesale price indices going up by about 3.7%, but inflation remained quite contained. And actually, we've seen, rents going up by about 10.7%. You take out rents from the inflation numbers, and you actually have a negative inflation in terms of headline. And a lot of it is from the developments in Jeddah and Riyadh. And we've seen expatriate workers. When I talked about some pressure, we've seen expatriate workers, particularly for the high-skilled jobs. We've seen some increases in wages there. But it's still not materializing on inflation. This is very, very contained. On the external front, current account has narrowed significantly last year. It's at 3.2% of GDP. It used to be 13.5% the year before. And frankly, we've seen that because the oil price decline last year. It's still at $82 a barrel, but you see that being affected, including because import growth has still remained quite robust. That said, reserves are quite comfortable. We still have net foreign assets that can cover more than 15, 16 months of import cover. If you look at the IMF reserve adequacy metric, we have a number more than 200%. It's like we're still well above what we would expect to happen. Now, one interesting development on the current account on the external front that we've seen last year is that clearly tourism has picked up. We've seen the travel services going up. I mean, the authorities have their targets on the tourism numbers coming in, the 100 million visitors. That target has been surpassed, but we've seen the contribution of travel services that is positive to the current account and a record number of 1% of GDP. We have a banking sector that is on very strong footing. If you look at the solvency ratios, if you look at profitability, that is also quite strong. And we had we've done over the past few months what we call a financial sector assessment program, which is the IMF's in-depth evaluation of the financial sector. And we found that it's in quite strong footing and is actually quite resilient to a number of shocks, including to oil price declining, including to a global recession, etc. There's enough capital buffers to resist those shocks. And here, one recommendation is to continue strengthening the strengthening the regulatory environment to deal with these risks. One risk that we had flagged was what's happening with mortgage growth rate. We've seen housing has picked up. There's also a housing target that needs to be reached. But that housing credit growth has moderated a bit. We've seen a bit less risks on that side. If the risk were to materialize, when we see another pickup in credit growth, our recommendation there would be to look at tightening the existing macroprudential framework. And if talk about credit growth, overall credit growth remains, let's say, 10, 11%. We expect that to continue. But the banking system still needs to mobilize resources on deposits. And to fund some of those projects, also will have to resort to wholesale funding. One issue that we flagged in the report is that the link between the state and the financial sector, or the sovereign and banking sector, is actually now becoming much more important. If you were to look at public sector deposits as a size of total deposits, it's now about 32, 34%. It used to be 20%, which means that there's more exposure to what happened to the public sector. Now, I talked about the past. How do we see the outlook? Quite positive. We've seen a moderation on private sector credit, but still we see that going strong, and we see a domestic demand that keeps going ahead. And let me here, take a pause, and I'm sure that Tim will raise that in the discussion. Let's talk about the fiscal space exercise that the authorities have done. This is an exercise where there's been a recalibration of the investment spending in terms of, looking at making sure that the projects can follow the capacity of the economy to grow without putting risks on the economy. This is where I'm talking before about reducing overheating risk, making sure that fiscal and external sustainability is there, and that exercise has been done. That is an exercise that we very much welcome. We think this is an exercise that is necessary, and actually in terms of outlook and growth and to make sure that we have investment that keeps coming, it's important that the results of this exercise be made public, because then there's more clarity about what is the investment going forward, where are we going, what are there new Vision 2030 targets? Some of the targets have been surpassed. And if you look at our forecast, we have a moderate increase in investment. We don't have what are the latest numbers, and hopefully this is something that could be made public, and particularly because it's important for investors to know. We hear a lot about, does this mean this project is going to be stopped or etc. And I think this recalibration is just one way of accelerating some projects, looking at some of the vision realization program and see where the outlook is. So what does that mean in terms of numbers? IMF, we love the numbers. So in terms of growth, next year we have non-oil growth that will still be quite sizable, probably non-oil GDP around 4.4%, tapering off a bit in the medium term. One piece of news we heard last year was that the extension of the OPEC Plus oil production cuts, that's going to be affecting a bit, but more the hydrocarbon. And here I'll talk about something that may come up later in the discussion, is that the link between the oil economy and the non-oil economy is not as strong today as it used to be in the past, because we have, particularly if we were to look at the government sector, because we have the link that is going now where the non-government sector, well, quasi-government, let's say, sovereign wealth funds, etc., are the ones driving domestic demand. And they're the ones as part of the projects. And I'll come to one of our recommendations there. So on the outlook, we have a story where growth remains robust, assuming domestic demand and some of these projects keep materializing, so spurred by domestic demand. We have inflation that remains contained, but we have, some of those projects also require imports that will need to accompany some of these investment projects, and we have a current account deficit that will materialize and will persist over the medium term. It still remains quite sustainable. I mean, if you were to look at the reserve assets, they are quite sizable, and there are also quite a lot of reserve assets that are held abroad outside the central bank. If we were to look at the fiscal front, the deficit is worsening compared to where we were last year, again reflecting some acceleration of some of these capital projects. So we have an overall deficit of 3% of GDP in 2024 is what we are projecting. We're expecting the targets to go between close to that, or we're expecting the deficit to remain close to that. What does this mean for debt? Debt is quite low. It's 26% of GDP, by many metrics quite low. Even with a deficit target of about 3% of GDP, we project that a debt to GDP ratio will remain around 35% of GDP by the end of the medium term, which is still lower than the 40% of GDP debt threshold that the authorities will have. Now, even with that, our recommendation on the fiscal front is that it's important to look at maintaining intergenerational equity, which means that we think that there's still more adjustment that could be made to make sure that over the future there is a constant revenue wealth that is maintained, given that what we expect on the oil extraction process. Now, what does that mean? Still more strengthening of institutions. I talked earlier about the medium term. I think it's quite important for medium-term fiscal framework to be in place, and so that the planning is happening over a multi-year period. It's also important not only to just diversify the economy, it's also to mobilize resources. So this year, or in 2024 already, Saudi Arabia went to the market, is one of the largest that went to the market in terms of bond issuance. But also one avenue is to increase non-oil revenue. A lot has been done on non-oil revenue. They have doubled over the past 4 years with the VAT rate being introduced at 15%. But also, there are some other taxes that are not really there. Property tax, for example, is not existent. In some emerging advanced economy, it can bring as much as 2% of GDP. The tax gap that we looked at is about 9% of GDP. And another component on the fiscal that I don't think we should forget, but would also be linked to the climate, is energy subsidies. So this is representing about 5% of GDP. That's a lot of resources that could be used for something else, which for Saudi Arabia will be quite relevant, given that they also have quite a nice targeting system. That's on fiscal, and maybe I'll finish with last but not least on the structural reforms. Look, the kingdom has engaged on a very impressive, significant strides on the structural reforms in terms of the laws, in terms of the regulations. Earlier this year, you have this commercial transactions law, which is expected to help bring more certainty about the legal regime. You have an investment code that was just passed in cabinet but will come into effect next year. We have some new amendments to the labor code. We have a new pension reform that's more long-term. And all of these reforms, before you had the bankruptcy law, etc., all of these reforms are, new reforms to streamline the business regulation. All of those reforms are there to help in enhancing private sector development. They're very much welcome. There's also some industrial policies. We raised in our report some flags about industrial policies because there are risks to that. We've seen some failures in some other countries. There's some safeguards that the Saudi government has put in place on that, but we think that it's important to follow up on these big structural reforms. Now, one question that we get is that FDI is not coming at the pace initially expected. It's still increasing, but not at the pace expected. I think that's maybe going to take a bit more time in terms of perceptions to change, but I think a lot of the reforms go in the right direction there, including what's happening on the labor market, the female labor force participation. Digitalization is very high. So a lot of the strides in that structural reform agenda will be necessary to increase non-oil growth. And if I have to finish something on the structural reform, I talked about clarity for investors. I think what's important to avoid the pitfalls of the past is that the structural reforms continue irrespective of what happens to the oil price developments. And this is really quite important. We think this is what got Saudi Arabia there in terms of non-oil growth, and I think it's important that that pace of reforms continue. And I'll stop here.
Good. Thank you very much, Amine. Let me turn the floor over straight away to Callen.
Well, thank you, Tim, and thank you to the Arab Gulf States Institute. It's great to be back. But I want to say first thank you to Amine and the work that you and your team do. I don't know if many of you are familiar with what the Article 4 consultations are like. There's, I think we get a lot of attention to the Saudi case, but members of the IMF member states can choose to make these reports public. So I read the U.S. report out of curiosity because I'd never read it before. And it was really interesting because there was a bit of a sort of pushback from the IMF economist on some industrial policy and tariff policy that is now more popular in both parties in the United States. And so it's important to understand that this conversation and the availability of information, of data, of transparency is a service to, of course, all of us, but also to the members of the organization. So it's tremendous work and really valuable. There was a strong recommendation I found in the report to put more public information forward, particularly on this recalibration of the Vision 2030 projects. And I agree that that is absolutely essential. And it's good that it's happening, right? But people want to know more because, especially on the foreign direct investment numbers, people want to have an understanding of, where there might be some scale back. And that's perfectly normal, and I think always was part of the intention of Vision 2030 to have some flexibility. but having a bit of a picture of the pace of that, I think would be very useful. The backdrop of the report and the general kind of fiscal planning in Saudi Arabia is very much in the context of disagreements from scenarios about where global oil demand is going. So we're in this period of decarbonization and policy adaptation to that, the increasing availability and affordability of clean energy in our energy system. And then we have this issue of really excess supply and overcapacity within OPEC and OPEC plus. And so that's been a little bit unsettling, I would say, in markets, particularly since October of last year. We have a lot of issues to think that there would be more sensitivity in prices, which has not really happened. So absent, really serious supply shocks because of conflict directly to oil production, or real weakening of the global economy. And this is where I think most of the sensitivity is coming from, particularly led by fears of recession in China. We are seeing this sort of expectation of a slowdown and a general kind of plateau of global oil demand by 2030, 2035. That doesn't mean that oil demand is like falling off a cliff. But for particularly a country like Saudi Arabia, this means that the scenario building, the kind of planning on fiscal policy is getting very, very tricky. The good news for a producer like Saudi Arabia is that in most of the scenarios that we see, whether it's from the IEA or even more private sector scenario building like what BP has done in the past, is that OPEC will be a stronger source of supply as we go through the energy transition. And so even though it may be a smaller pool of global oil demand, those producers that will play a more important role will continue to be countries like Saudi Arabia. It's really hard to estimate what that means for government spending, right? And so this is sort of an exercise that many scholars and analysts are trying to do around the world, but it could be so severe that we're looking at like a 90% drop of revenue, of government revenue. So how do you plan for that, and how do you think about the pace of that fiscal cliff? We don't really talk about that in the Saudi case the way we used to, and this is what Vision 2030 is created and designed to accommodate, right, and to prevent. But there's absolutely a reality of a sharp decline in oil revenue. And what year are we looking at? Well, probably like 2090, right? A long time from now, where you see that kind of edge of the curve of that very, very steep decline. The energy transition, though, has given the political economy and the policy world of Saudi Arabia a real rationale for change, right? And so this means that there's opportunity for new sectors in clean energy that didn't exist before. But we still see this strong correlation between oil price and non-oil GDP. So even though we're seeing growth in non-oil sectors, they grow faster and grow more when oil prices are higher. That's one of the reasons is what Amine just mentioned. If you've got 32% of deposits in your private bank sector coming from the government, those deposits are made when oil revenues are high. And so the linkage between how the rest of the economy grows and how oil revenues grow still remains very, very strong, even as we see this important and I think really we should be kind of remarkable growth in non-oil GDP. So how do you deal with that, especially when you need to think about constraints on spending? That's a policy challenge, and it is exactly this issue of what we call intergenerational equity, right? So not the idea that everybody has the same for perpetuity or that everybody has the same that their parents had, but there has to be some sort of changing of people's expectations. That's the renegotiation of what we think of as a social contract, but also in kind of norms of, what are your wages expected to be? What are people satisfied with? How much debt are you personally willing to take on? And to kind of plan in your own spending. We are seeing these pain points, particularly in housing costs. As Amine says, inflation is not really an issue in Saudi Arabia. It's been very contained, but housing costs have seen maybe like 9% inflation year on year. And so for young people, that's a big deal. In women's labor force participation and mortgage accessibility, those were huge victories of exceeding Vision 2030 targets. We are seeing a bit of a plateau in women's labor force participation. I think that's sort of normal, and anecdotally, I mean, the young women that I work with in the kingdom, what I'm seeing is a lot of people going back to school, this sort of re-credentialing, right? Getting a second or third master's degree. Of course, that's not across the general population, but it does tell you something that that women are maybe being more selective about where they want to work, how they plan their careers. And I think that's not a bad thing, and there will always be the concerns of family life balance, and so maybe we're hitting kind of a saturation level of women's labor force participation. But regionally, it's very strong, and I flew in from Jordan last night, which has just appalling low numbers of women's labor force participation. So the Saudi cases is looking very, very good there. Debt instruments are also a little bit of an issue of how we look at the government's balance sheet, and this was something that I think is in the report, but also something that maybe we need more information about. So yes, the debt to GDP levels are not a problem, and even if they get into the 30, 35%, or even 40% range, that's not on a global scale a bad thing. But one of the strategies now is for different government entities to take on debt on their own balance sheets. So we see the PIF, for example, doing its fourth bond issue of just this year. And that's not a bad thing either. You've got lots of state entities which you can leverage, but in the way you account for that leverage and you account for that, the burden of the repayment of that debt, I think is where analysts and the IMF and others would like to see perhaps a bit more information. I've written somewhat pessimistically about trade and economic integration across the MENA region. Really where the growth is happening is in Saudi Arabia, the UAE. But there are some areas where I think we could see opportunities, and particularly opportunities for the kingdom to be more integrated in trade and investment in a wider region way. And so that's the growth of the financial services industry. We've certainly seen this huge growth in mortgages in the private bank sector to Saudi citizens, but that could be expanded in loans to businesses region-wide. We're also seeing the growth of new kind of financial products and instruments, including trading in carbon. There are new platforms in Saudi Arabia. That could be a growth industry as well. I know one of the questions that Tim has been interested in is, and everyone is interested in, is the giga projects, and particularly Neom. Like, how much does all of this cost? And so the big number price tags are like $500 billion. But that's like a long-term kind of estimate. It doesn't mean that it's the right now. And so if you look at what the spending has been, particularly on Neom, it's been from 2017 to May of 2024, by Mead's estimates, about $39 billion in Neom. So where has that money gone, and where has the biggest spending kind of happened? It happened in 2022, was the biggest outlays. That was when oil prices were a lot higher, right? So there's a reason for that. So 2022, there were about $14 billion in contracts awarded in Neom. This year, or to May of this year, about $4 billion in contracts have been awarded. So that just shows you, again, this correlation between oil revenues and spending that's happening, but also kind of the pace of thinking about project awards and how those go. In terms of how you choose what to spend on, right? Interestingly, the kind of largest outlays, the biggest project awards for this year have been in water desalination. I think that's a great piece of information. Why? What does that tell you? It's not a shiny white elephant. It's basically the infrastructure that is absolutely necessary to build a city, but also to do the big projects, particularly in green hydrogen. So you have to have the capacity to desalinate water, to put it into electrolyzers that then separate the molecule and create hydrogen from solar energy. So that, I think, is positive. If you're going to spend $4 billion, that's a good way to do it. I don't want to go too much over. How much time do I have? A couple minutes. I mentioned the inflation issue. Yeah, let me say one thing about China. So I think China is probably the Saudi economy's biggest vulnerability. That's true for all of us, right? That's true for the global economy. But as we see a slowdown in the Chinese economy, the report says, and spillovers from China to Saudi Arabia suggest a 1% drop in China's growth would lead to a 2% decline in real non-oil growth in the medium term. That's a real sensitivity, right? And so combine that with not just a decline in oil demand. I mean, reports that I've seen that a real sharpening decline in Chinese oil demand and in the Chinese economy in general could lead to a decline in oil price of $6 to $9 a barrel in the medium term, like the next, well, actually in the shorter term. If you space that out a little bit longer, what is China doing in Saudi Arabia? Well, they're a key partner in renewable energy projects, in the construction of plants that build wafers and solar panels. They're a key partner in the Saudi company, Aqua Power, that is deploying renewable power on a global scale. The inability to continue those flows, so it's not just about oil demand, it's about that Chinese kind of engagement with the Saudi economy, is vulnerable to what we already see as challenges in foreign direct investment levels, but also in some of the diversification projects inside the kingdom and the things they want to build and make. So I don't know, that's just a little bit of an outlook, but again, huge congratulations to doing this on a repetitive basis. Tim's done this work too. It's not easy, and it's also credit goes to the Saudi government for engaging and sharing data and information, and being more transparent about the budget and about reforms in general.
Good. Thank you very much, Karen. So I'm going to take the moderator's prerogative and ask a couple of questions. There's some great questions coming in online. I encourage you online to keep pushing those questions in. So I guess in terms of questions, I mean, two areas that I think really interest me. One is we've seen oil prices come down since the report was finalised. We've seen OPEC Plus already announce a 2-month delay in the production increases, with I think an increasing number of commentators suggesting it's going to be really hard next year to restore the production cuts, at least to the degree that OPEC Plus has announced. How does this change the outlook for Saudi? Of course, we don't know whether oil prices will stay down, but let's assume they stay around $70, $72 a barrel. Oil production stays at 9 million barrels a day rather than increases up. How does that change the outlook for non-oil growth, current account, and also the spending on the projects? So that's one question. I maybe put it to both Karen and Amine. The second question is, I think Karen and Amine already raised this, is the cost of the Vision 2030 projects. I don't think there's any clear estimate of how much these are going to cost. The Article 4 report has the 5 giga projects that will be funded by the PIF, something like 630 billion. There's a report by Knight Frank came out the other day saying infrastructure projects since the publication of Vision 2030 is $1.3 trillion US, of which only a small fraction have so far been contracted. So there's potentially this huge amount of financing needed going forward. So I'm still, myself, puzzling how this financing is going to be achieved. Clearly, it could be over a long time. Clearly, there might have been some scaling back in some areas with the gap analysis that the government has done. But can you give us any sense on, both costs and financing options? So, Amine, do you want to kick off, and then we'll
start.
Yeah.
Look, let's just say our baseline and our scenario is based on what futures looked like at the time we went to the board. So if you were to look at the price that we had for 2024, we were at about $82 a barrel, and about the same for 2025. If you look at futures today for 2025, it's probably closer to $74, although today the spot is below 70 at 69. What does that mean? Depending how protracted this is, But if you were to look at just a standard sensitivity analysis, and we are keeping, we do not deviate from OPEC Plus. We may have different views on what that would mean for the oil price, but we go with what OPEC Plus has announced and the phase schedule of oil production increases, where for Saudi Arabia, now the 9 million barrels a day production is going to be 10 million barrels in December 2025 instead of the September initially announced, or October initially announced. Now, if you look at sensitivity analysis, a $10 a barrel decline will reach about 2.5, 2.7% of GDP, will increase the fiscal deficit by 2.5% of GDP, and will increase the current account deficit probably by 2.7% of GDP. And by orders of magnitude, if you were to look at a drop in oil production, 1 million barrels a day would probably get us something similar than what would happen with $10 a barrel. So it will be quite a drop. Now, the question that Tim asked in the past, if you had such a drop, then you'll have an automatic link with non-oil growth. There's like very high correlation. The idea here is that we have a vision, we have a funding plan that should be in place, and this is why it's important to really have a medium-term planning of what are these investments, what are these spending, which should not depend on what's happening on the fluctuations in the oil price, particularly in the short term. And therefore, non-oil growth, we would expect it to remain robust. PIF had announced that they will go from $40 billion in terms of investment to $70 billion in 2025. If that's the case, then that domestic demand will still be there, even if the oil price is going down. Now, at the end, as the authorities did this year, there may be some recalibration, some look at some of the projects. But given the new format, this is why I keep emphasizing again, this medium-term fiscal framework was announced by the authorities. They have some spending. They have some funding identified on the central government. This is why the PIF and other institutions, NDF is going to go later, is issuing that instrument, is to keep on a certain spending path, which has to remain realistic and also avoid some of the overheating risks that we talked about. Now, to the second part of the question on the spending on projects, we don't have more information than what we have in the report, but I think I want to piggyback on something that Karen raised, is that, look, some of those projects, we have all of these numbers, and Neom, etc., but Neom is not supposed to be finished by 2030, right? So those are some of those projects will take more time. I think it's important that some of the projects, what is known, is that a number that is known is National Investment Strategy. What's the number that's publicly out there? 12.3 trillion Saudi riyal. Now, of that number, what is now the new National Investment Strategy? There's been a recalibration. There's been acceleration of some projects, some strategies that are later. So I think that's the number that the authorities have done this fiscal space exercise, including funding gaps, with some assumptions that I think will be important to be public in trying, and then that will help determine what will be the impact on real sector economic activity. But we've seen these MEAD project numbers and etc., and I think it's important that the plans are also made public, not just the execution. And let me just, Karen talked something about transparency. I think what's important on transparency that we've seen is also a lot of the publications that didn't used to be there. So when we talk about PIF, we now have financial statements that are published. And we're able to get some of the information that just wasn't there 3 or 4 years ago. And the next step is to really get a good sense from the projects and from what's happening there about what is the public sector balance sheet. And I think that's one of the recommendations that Karen pointed out. We had the report that is a key recommendation to get a good view of going forward, what will be the impact on real sector economic activity.
Thanks. Karen?
Yeah, just to follow on to what Amine just said, one of the good parts of borrowing more through various state-owned entities is that when you issue a bond, you have to issue a bond prospectus, which puts information into the the public sphere about the balance sheet of that entity and about the shareholders or the owners, meaning the government. So that has increased. One kind of side point to that, though, is that where the funding sources come from. So in the PIF, some of the additional funding which has come recently has come from a transfer of shares of Aramco, of the national oil company, but also of earnings of the dividend of those shares, right? Increasing the dividend of Aramco has meant more money going to these new shareholders, which is the PIF. In a lower price oil environment, can the company sustain those payments? I think is a very valid question, because there's money needed to invest more in the operations of the company, particularly in kind of a longer term plan of which Aramco does very successfully, of creating an oil product that is lower in its carbon intensity. But that takes investment, right? So how the company itself decides where to spend ultimately has an impact on the dividend and then the amount of money that goes into the state entities that are shareholders. More broadly on the impact of weaker oil prices right now and through next year, and who knows? I mean, there's a lot of different ways this could go. I'm not an oil trader or an analyst, so I don't pretend to have insight into that, other than to say we could see extreme volatility based on a supply side shock, which would be, let's say we have a Houthi attack on an oil facility, God forbid, inside the kingdom. That would have an impact. Or that we see a direct conflict in the region with engagement between Iran and Israel. That would change the picture. The other thing that changes the picture is something that might be impacted from our own politics in the United States, which is the change in administrations. If we have a Republican administration after the election, we have President Trump returning to office. He has said he would enforce existing and perhaps place new sanctions and restrictions on Iranian export of crude. That could change the market, right? We have these same sort of issues in Venezuela, and of course, tougher enforcement of sanctions on Russian crude. So all those things could be more supportive to a higher price in Saudi Arabia. The China story, as we've talked about, could be supportive to a lower price, which could be pretty damning, right? Pretty scary. There's also the issue, and I think it bears talking about, of OPEC and OPEC plus cohesion. And so this could really change things. When we had 2016, and then of course also in the pandemic in 2020, we didn't have such a good relationship between Saudi Arabia and Russia, and also this effort to kind of lower prices to take on more market share also from U.S. shale producers. That, I think, could happen again. It's possible. Doesn't mean it's for sure, but I think you're going to see a lot of pressure on OPEC producers as they, would like to unwind some of these cuts. Saudi Arabia has taken the lion's share of that responsibility. They pay the highest burden in terms of what this does to their oil revenues. And so you can imagine a bit of a gamble where they might say, okay, we're going to produce more, even if that's a short-term price decline, because we want to get some other people hurting a little bit. So, these are just possibilities. We could see a whole lot of changes even between now and January, right? Because of political changes, because of OPEC plus cohesion issues. So that's not a long-term planning helpful thing, but it does mean that that the government could have more or less than it is said it would expect. I disagree a little bit on Amine's point about, committing to some of these large expenditure items in the giga projects and then having to do it if oil prices are very weak. Saudi Arabia is a government that retains this very much top-down flexibility in policymaking. So you can shut down a project without a whole lot of conversation about it. And I don't think it's not great if you're a foreign investor in that project, but it's not a bad decision from a political economy's point of view. And I think more and more we will see decisions on these projects based on the way citizens see their performance. And it's already happening, actually. So where the spending has been more consistent are in programs where people live, that people see. So whether that's in Qiddiya or it's in Diriyah and or places around the capital, if it's in transportation systems that people are going to use, like the metro in Riyadh, people are generally in any political economy, but even in Saudi Arabia, more receptive to spending to projects what they were going to use. They're going to improve their lives and make their commute cheaper, make their job opportunities better. So I think the government should have the ability to change its mind. But yes, communicating that in a more consistent way and regular way, it certainly would be good for everybody.
If I can just come on that, top-down flexibility I think is important, and I think it's there. I think our main point here is to avoid the ratcheting up and down, and then that comes back to it's quite important to put prioritization of the projects, select the right projects, and see on the medium term are those projects that we can do. Then you have some you could call optional projects, etc., that you can do. But I think it's important, for your growth to avoid the up and down, because then that's exactly the pitfalls that we had in the past. And you're right. Some of the projects that are working, for example, we look at where we are on renewable energy. It used to be 0.8 gigawatt capacity, went to 2.8, now 23. Then all these standard projects are going fast, and this is also in line with their net zero emissions. So those are projects where there is visibility, and there's a few projects like that where the visibility is there. Then so obviously and I think the authorities clearly said that they can change their mind, they can accelerate and look at, but that prioritization in the first place, including on designing the projects right in the first place, I think is what's very important, because then that's going to determine the spending that would materialize.
Do we have questions in the room? I have quite a few online. I'll go to yes, Doug.
I think this is to Amine, but Karen, if you have questions. I was struck by the dichotomy in the inflation numbers. So my first question is, what Saudi policies have been effective in keeping most of the inflation low or negative? But for the housing numbers, is that housing inflation spread evenly across the country, or is it concentrated only? I was struck by the expansion in Riyadh, the growth, the traffic. Is this really in Riyadh and people moving to Riyadh? So does this have the same impact in Khobar or some other part of the country as it does in Riyadh?
Look, a good question. I think really the big development projects that where you see a lot of this pressure is in Riyadh and Jeddah. There is now a new consumer price index being done. That's going to be actually expanding this, including in terms of the household survey and what we do, where we may get some different results, although housing will still be quite important. What has kept prices down, I think transport, you still have some subsidies that are there in terms of caps, and the appreciating exchange rate has helped. You're seeing it, by the way, the story that you're seeing in Saudi Arabia is not unique in the GCC. This is something where compared to other countries. One surprising result to us, particularly post-COVID, was that at some point we had wholesale price indices that was going up at 14-15%, but that still didn't materialize. Again, because at that time we had the opposite scenario, because housing prices were still low. But now, and keep in mind that in the CPI of Saudi Arabia, housing and rents is 21%. So it is a large component of that CPI.
Other questions in the room? Could you please just introduce yourself as well?
Of course.
Thank you.
I'm Kathleen Davey Mystery, and I run Mystery Advisors. We help companies expand to the Gulf region. And very short. So my question is to be able to finish a massive project like Neom, what percentage of funding would have to come from foreign direct investment and or one of the other sovereign wealth funds like Mubadala or Kuwaiti Investment Fund? Can you talk about that to help educate me?
I would like to be educated myself. I'm not sure I can tell you about how much in terms of the funding is needed for Neom, in terms of FDI, sovereign wealth fund, or even in terms of other direct debt instruments. But I can tell you the more FDI there is, the better in terms of long term. And I think the question here is that a lot of that FDI so far is still on some of the energy and not yet in some of those other projects. And maybe, some of the wait and see attitude comes from this funding gap exercise, but also from proof of concept. A lot of those investors there's still some wait and see attitude for some of that FDI to come in. Now, which proportion is there in terms of seed money? I can tell you the sovereign wealth fund is quite present, but percentage, which I don't know. If you know, let me know.
Other questions in the room? Yes, Kristen.
Hi, I'm Kristen Diwan. I'm here at the Arab Gulf States Institute. Since we're on the monetary policy, I'll stick on the macroeconomy. I'm just trying to understand. I think we're kind of getting a picture that in the future there might be a bit of a budget shortfall, and I guess we've seen what the Saudis have done before, turning to Aramco shares, the debt market. How much potential is there to keep going, funding that way, or going to domestic banks? I just wanted to get a bigger picture of where, if they're not getting that investment or foreign investment, then how much avenue there is, where Saudi's likely to get that kind of money, and what the appetite, I mean, not as much a financial person, but their ability to do that.
You want to start? I start?
Yeah,
Always me start.
I can give an example. So talking about the funding gap, I mean, the PIF has said they're going to spend $40 billion a year in the domestic economy, maybe almost double that next year. But what's more of a proof of concept is when you use other people's money, right? And so, for example, the green hydrogen deal with Aqua Power and Air Products, that was an $8 billion arrangement, and it relied on 25 different financial institutions in financing. Many domestic banks, international banks, Chinese banks, you name it, everybody came to the table. And I think the exercise was to demonstrate everybody can come to the table, right? And so that was very successful, and that should maybe be a model for how you do these other big projects. I think, again, this kind of clarity on which projects have priority is very helpful, because then you start getting people lined up to try to finance them. There's not a paucity of infrastructure financing or infrastructure investment. It's out there. It is actually happy to come to the table. But it's more kind of knowing who you're sitting next to, which I think is what matters. So I don't know. I see a lot of potential there.
Thank you. And Karen talked more about the financing. Let me go back to the budget. And I did mention 3% of GDP deficit and likely staying going forward. I think one important thing to look, if you look at our numbers, is, and we assume that debt goes to 35% of GDP. One thing I didn't mention is that we're also assuming that central government deposits are staying at around 10% of GDP. That's already something that can be used, obviously, depending in terms of the magnitude. Another thing that I mentioned in the past is that there's a lot of potential on the tax front, on revenue mobilization. Of course, you have to look at political economic considerations, social considerations, but on the 3% of GDP deficit that I talked about, there is not one single measure. In other words, the non-oil revenue over non-oil GDP is about 18.8% of GDP and remains constant. In other words, if they were to take measures, and there's a lot of room on exemptions, including, by the way, on Pillar 2, global income tax, to make sure that the multinational corporations don't pay the tax to another jurisdiction but pay it in Saudi Arabia, and on property tax, etc. There is quite a room to increase the funding from the budget. Now, where that would be, but that could help compensate for some of the loss of revenue on the way, and that will help in the diversification agenda that the kingdom wants to go into. So there's a lot of financing available, but there's also a lot that can be done domestically to increase revenue mobilization.
Let me take a couple of the questions that are coming online, and there's a couple around climate change issues. So one is climate and extreme weather is likely to impact the kingdom actually the question focuses on utilities, but maybe let me put it more broadly. It's likely to impact KSA. What are going to be the costs in terms of public sector mitigation and adaptation measures that are going to be needed there? And then the second one is decarbonisation costs is likely to be prohibitively high in some sectors related to oil and gas, but also, I guess, areas of petrochemicals and so on. Has the IMF done any analysis on this point?
Okay.
That's all you.
That's all me. I was like,
Are you going to climate change if you want, Karen?
Look, I think on the cost, we haven't really looked at all of that. There's a lot of figures in terms of the investment that's been done, clearly on renewable energy, but there's also a lot of investment that was done on energy efficiency. There's the global methane pledge. There's carbon capture with Aramco is also putting quite a lot. I think the costs are out there. What's not clear is what is the total cost and investment, the cost of the investment needed to reach the target for 2030, the NDC target of 278 medium-term carbon equivalent, or the net zero emissions target by 2050. And I think some of that analysis still needs to be done. I can tell you that last year we did an exercise where we tried to look at what would be the impact on the economy of, let's say, the authorities trying to reach the net zero emissions target. And, depending on where you are in terms of the oil price, we use an oil price in the long term, not as dramatic as some of the IEA prices that Karen talked about, but mostly assuming that over the long term you have both a combination of supply shocks under investment and demand shocks that will keep prices relatively, let's say, around 82 or barrel. And the cost on the GDP was actually not as high as we actually thought, because some of the oil price will stay high even after reaching this net zero emissions target. And actually you can get, when we talk about trying to decarbonize and try to reach the net zero emissions target, just for 2030, if you were to reduce the energy subsidies to zero, you will already be 1/3 of the way there in terms of reaching your net zero emissions target, which is already something that's quite, I don't want to say easy, but it's something that can be done. But of course, the political and social economy aspects of that have to be looked at. But on energy subsidy, I'll reiterate again, the targeting mechanism that is available in Saudi Arabia is a lot more sophisticated than in many other countries to try to do that.
Karen, there's a question directed to you here on, Karen, why do you think OPEC is stronger as the transition moves further? I think you said in your opening remarks. And then maybe a second oil one just directed to you, which isn't directly directed to you, but let me direct it to you.
I'm being voluntold.
Given we're on oil. How long do you think the kingdom can continue to withhold supply if the market fails to tighten next year?
Yeah. Okay, so it's not my estimation that OPEC will be will produce more of global supply after 2030. That's BP's actually estimate from their 2023 energy outlook. And other entities have made the same assessment. Why is that? Because of decarbonization policies and what we expect for some producers to kind of fall out of the market, also because of underinvestment by some producers. And so that means that not just OPEC, but Gulf producers, really UAE, Saudi Arabia, will have a hand in this business for longer and be a bigger part of production. And that, depends. But I think most people would probably see a shortening lifespan of U.S. production. I mean, we're talking, decades, right? Between 2030 and 2060, basically. Not just because of our policy decisions, but also because of the geology of shale, right? So many people expect that U.S. production and Canadian production will start to decline. So that's why. The second question was more about OPEC cohesion, right? So I don't know, right? But it seems like there's tremendous pressure. One of the priorities that OPEC and the OPEC Plus members have really tried to do is not to make like surprise announcements. So they've been pretty consistent about that, and there's been, I think, strong discipline led by Saudi Arabia. But yeah, everybody's wondering, right? When prices are in the 60s, like, what's going to happen? So there's tremendous pressure on them. I think no one was really surprised that the unwinding of October is not unwinding. We'll kind of probably check in again after the election in December, and then there'll be other opportunities. I mean, most of these cuts they were not all at the same time, right? So some are still scheduled to be in place into the end of next year. So it depends kind of which ones you're talking about. So they've got a little bit of leeway. But I think the challenge is maintaining that kind of political cohesion within the organization and within the Plus members. And it's an unenviable position, for sure.
Let me ask you both a much broader question, and that's we're focused very much on the reforms in Saudi Arabia, which, as we said, have been very impressive, and I think gone much further than people would have thought a decade ago. But Saudi Arabia is not the only country in the Gulf region reforming. We're seeing a lot coming out of the Emirates, Oman, Qatar, and in many ways they're all sort of seem to be aiming for the same sorts of markets in logistics hub, travel and tourism, entertainment, AI come to mind. And I'm just wondering how you see that competition coming from elsewhere affecting the prospects for reform in Saudi. Is it helpful to Saudi to have this competition from elsewhere in the region? Or is it sort of, effectively all the countries going for the same sort of resources and, somebody will win and somebody will lose, and how that'll come out?
I mean, I've always seen competition as a good thing. I think and there's proof. If you look at, and I actually created a tracker when I was at AEI of kind of the reform agenda across the GCC states. So if you look at policy changes from 2015, the tracker went until 2021. It was very obvious that there's this diffusion happening, right? So you start reforming labor markets, you start introducing taxes, you start changing the regulatory environment around business and ease of doing business. The neighborhood reacts, and they start doing the same thing. I think that's overall very positive. The thing that I think is different about Saudi Arabia is its size, right? It's just a much bigger country population-wise, landmass-wise than its neighbors. And so the opportunities are different. The liabilities are different. You've got more people to deal with and to pay for. So, that means that when you're looking 20, 30 years from now, in terms of per capita wealth, or if we divided up the sovereign wealth funds among citizens, you get a really different picture, right? So that intergenerational equity issue is very, very diverse across the GCC. And so that contributes to, Kristen's done lots of work on this idea of nationalism within the Gulf states. So we used to have an understanding that there was more of a Khaliji identity, a more shared identity, and that was politically part of the Gulf Cooperation Council, this agreement that you would have kind of equal benefits as a citizen of one Gulf state in another in terms of access to healthcare or as investment. That will become more tested, right? And that's why states reinforce this idea of national identity, because it gives you a mechanism to explain to citizens why you may not have what your neighbor has in terms of benefits or resources.
I agree with Karen, and I think on this competition is good. There's a lot of this reform. Look at now at all the countries in the GCC. Each and every one of them has a vision. They all go 2030. They're going to be updated to 2040. A lot of them are in the reforms. There's some countries in the GCC, including Saudi Arabia, that's moving faster than others. There's a lot more transformative reforms. I think what's important in some of those reforms is the implementation. I would say what's also important is to avoid a race to the bottom in terms of, for example, providing incentives. So when we talk about IP, this could be, if you were to look at what would be, if you were to ask companies coming to Saudi Arabia, what are the top 3 constraints to you coming, they're not going to mention taxation and incentives. The 3 that are going to come in are going to be access to land, something I just said, access to finance, and labor in terms of skills mismatch and human capital. You have these, and you're going to get all of that investment. I mean, the fact that you have competition at the end, depends on the industries. Tourism sector a few years ago did not represent much. Today it's 4.5% of the economy. I think there's quite a lot of growth there. You talk about AI, a lot of the industries on AI, there's a lot of investment being done. Microsoft just announced numbers more recently. I think these are all some of the growth avenues, and the level of digitalization in Saudi Arabia is very high. So there's a lot of growth on ICT and etc. Those are some of the diversification sectors. We are not seeing that yet. I mean, if you look at in terms of GDP, in terms of the share of oil, it has improved below 40%, but it's still quite important. If you look at exports, if you were to look at non-oil exports, where is it coming from? A lot of it is still petrochemical sales, so a derivative of oil, again, coming with China, high dependence on China. So there's still a lot of growth in those areas and in the financial sector. So I don't think that, but then comes back also to the idea that it would be good to get GCC regional integration, including when you have these trade agreements that are being negotiated, because they probably have more power as a bloc in that sense. And cooperation, I think, would always work out good.
Okay. Maybe, Amine, a couple of fiscal ones for you online. So the first one, how important is the break-even oil price for looking at the fiscal, particularly given the debt is relatively low? And then secondly, what do the IMF projections assume about the Aramco dividend for 2025 and beyond, given this is helping the budget significantly in 2024?
Thank you. On fiscal break-even, it's not a secret that I just don't like that number. And the reason I don't like that number is that fiscal break-even oil price is like a yo-yo. It depends on what's happening on non-oil. If today I'm at 9 million barrels a day, I give you one fiscal break-even. If tomorrow I'm at 11 million barrels a day, I'm going to give you another break-even oil price. So, that's a figure I don't really look at a lot, although I know the market or some news love to quote that number. I know we also report it on some of our reports. And what matters is really what is the fiscal sustainability, and what is the medium-term fiscal framework, and what's the deficit target that you're going to have include based on certain assumptions on revenue and spend, and is that sustainable, right? And so that's more a question than saying today the break-even price is 80, tomorrow it's 110, because there's a lot of decisions that can be made that would change what that fiscal break-even price is, or that oil break-even price. On IMF projection, I think the Aramco dividends are there. The special dividends are also assumed to continue 2024-25, and then we will see what other announcements are being made for future years.
Okay. Good. Yeah, Bill.
I just wanted to ask you a question about the deficit that you talked about. Is it unusual for an oil-producing country like Saudi Arabia to be running a deficit at a time of relatively high oil prices? The general pattern out there, as I've seen it, just looking at it from a distance, is that the countries run a deficit when oil prices are low, and they tend to have a surplus when oil prices are high. I just wonder if there are any consequences to that pattern, if you see it.
I mean, I think that what's important is to try to look at the sustainability and what the buffers that you have, and whether this is a deficit that can be sustained. And that's why you look at it on overall basis. Actually, the number that probably I like a lot more than the headline number of overall deficit is the non-oil deficit. Mm-hmm. And if you were to look at the non-oil primary deficit, it's actually even higher, it's 31. But even under the baseline, there was a slight deterioration last year. But even under current spending, including when we expect investment to increase, that part of the non-oil primary deficit is actually improving by about 8% of GDP. We think that could be improving more. But that's really one of the measures of the fiscal stance that we look at. So, it's okay to have a deficit as long as it's sustainable and when we look at it in terms of the debt sustainability. But I come back to a point that was raised earlier that also Karen pointed out from our report. We're only looking here at a partial picture. The numbers that we have, particularly on the projections, are only on central government. That's why it's quite important now that, in the past, when Tim was in my shoes, he was looking a lot at central government, and a lot of the investment spending that we were seeing, we were clearly seeing it on central government. So we had a good picture of what was happening by looking at the fiscal, at the central government picture. Now, we have other entities that are doing spending or investment spending that used to be done by central government. And some of the resources of the central government have shifted to those entities. So the PIF, the NDF, and all that. So it's important, including looking forward, that we look at public sector balance sheet and see what is that true fiscal stance once we have that whole picture. And I think that's actually what we are recommending. I know the government is looking at the public sector balance sheet, and I'm hoping for the next Article 4 that we can have something a bit more holistic than just the central government.
That's it.
Okay, yeah, go ahead and then.
That's called a two-handed intervention.
Use this one.
Can you just hold 1 second? Yeah.
Okay, I'll just use this. Just a clarification, does that mean that if you were to take into account all these PIF entities and stuff that are spending money, that the deficits actually could be larger right now?
Well, it depends what is it that you include on the revenue side, right? Because that's important to look at it on the public sector balance, right? You have asset under management of the PIF, but then what are the revenue flows that they also have that are not captured? And then what's the spending? So the spending picture is can be done. We could probably make projections if we assume that the announcements are there, and then we have discussion that if you go from 40 billion to 70 billion, if you just do the math there, then clearly you have a higher debt. But then you should not forget the revenue streams that they're also getting, right? And so that picture will depend how that would affect the picture.
So I guess one of the things, right, is with the transfer of equity, Aramco equity to the PIF, they're now getting more dividends, which you would normally include in revenue. Right, so it's lost out of the central government, but it's now revenue for the PIF. So I guess you need to account for all of that. Yes, please.
My question was, we see a lot of GCC countries that are diversifying their economies right now, and something that I wanted or was looking forward to see today is we saw how Qatar had a lot of economic gains after the World Cup. And now it's announced that Saudi Arabia is also going to host the World Cup in 2034. I just wanted to see if you had any insights on knowing whether Saudi Arabia could have as much economic gains as Qatar did or is continuing to have after hosting the World Cup. Could they do better than Qatar? Is there a chance of it going wrong? How does that play with the plateauing of oil prices that you mentioned earlier around midway of the century, 2030s?
Okay. Let me just repeat the question for the online audience. So I think it's Qatar has got a lot of benefit out of hosting the World Cup in 2022 in terms of infrastructure built, arrivals and so on. Saudi Arabia is in all likelihood going to get the World Cup in 2034. Can we see similar gains for Saudi? Could the gains be bigger, and what I guess ultimately will determine the size of those gains?
I think it's important to look at the investments that are going to be made, but also to learn the lessons from Qatar on what has been to sustain it, because after holding some of those events, it's not always clear that the growth is sustained. And I think there's lessons there on making sure that some of the stadiums can be reused, etc. But you went all the way to 2034. You don't have to go that far. 2030, you have World Expo in Saudi Arabia. You have the Asia Games. You have the Winter Asia Games. So there's quite a lot of events that will also happen before that, which also will require some build-up of that infrastructure. And again, given that we know those events will happen, we know that some of that investment will materialize, and some of it might also be used for other events, including the World Cup. So I think, but again, prioritization and proper project selection will be important.
Karen, do you want to? add anything?
No,
on that?
I mean, I don't like sports. Everybody knows this about me. So, generally hosting the Olympics or the World Cup, you're not actually making money.
So,
Just saying.
let me pick up a question that came in online, and it says, you say the non-oil sector continues to grow, but isn't it mainly linked to public investment, which is itself linked to oil in one way or another? And then also, parts of manufacturing sector are, dedicated to supporting the oil industry, and I guess part of the services sector as well. So is there a measure of real non-oil sector that, takes out the impact of public investment and, directly servicing the oil sector?
I mean, that comes back to the point earlier, right? It all depends what you do with that. Do you keep linking it to oil money, or do you have that medium-term framework where some of the spending decisions, at least on priority projects, are still, identified and to continue given the funding? There's funding identified for those projects. So the link is not totally gone. But there is some de-link because some of those projects are part of a plan that will still materialize, given the sort of course, if prices completely collapse and the revenue, there may be a recalibration. But I think at least in the short term, we still expect that link to be there in terms of non-oil demand still being supported by this investment. You can call it, PIF or others, but I do get the point that is, let's say, somewhat public related. But what's important is not to stop it just because oil price today at 69, as long as it is a project that is properly identified and implemented.
Okay. Maybe a couple of questions on structural reform issues. So one, Vision 2030 emphasises the key role of private-public partnerships and privatisation. How does the IMF assess the success in these areas, and particularly in terms of attracting domestic and foreign investors? And then secondly, again to you, Amine, can you comment on progress with labour productivity in the Kingdom in recent years?
Thanks. On PPPs, this is something that we very much welcome. I think there's a number of PPPs that have been announced in Saudi Arabia in the energy sector, outside the energy sector. I think these are good to enhance private sector participation, increase the returns. What's important here is to ensure that the risks are actually captured and that we don't get contingent liabilities going to the government. I think there's a lot, including when the government has to do a guarantee or when the PIF is part of those. And I think this is some of those risks are actually being assessed, and I think this is something that will help in reducing possible risk to the government. On progress with labor productivity, you would have noted that we did flag that. So if you look at total factor productivity or productivity in Saudi Arabia and also other countries, it has gone down. It has declined. This is not unique to Saudi Arabia. This is also happening in Europe, etc. And but what's important is to look at what's happening on non-oil, and even more important is, and one of the aspects to look at also is on labor. On labor productivity, some of our work has shown that labor productivity has stabilized, and actually, if you look at labor productivity of the private sector versus the labor productivity of the public sector, after Vision 2030, although we don't control for consultants, etc., we did find a bump in labor productivity on the government sector relative to the private sector. So some of those reforms are bearing fruit. I think there's a lot more that can be done, including on the wage premium and all of that we see between the expat and the Saudi worker. But we've seen some increase in labor productivity in the government sector.
Are there any more questions in the room? Yes, please.
200.
Yes, hi. My name is Joseph, and I'm a political science major. My question is for both Amine and Karen. Comparing Saudi Arabia and the UAE when it comes to religious freedom. In the UAE, the religious freedom project was more of really embraced through and through in order to create like a global, international economic environment that is attractive to everyone. Versus in Saudi Arabia, there was a small push during King Abdullah's era for religious tolerance. Mostly, it was for people outside the kingdom, sort of creating this perception that Saudi Arabia is religiously tolerant, but in Saudi Arabia there isn't really much. The current Saudi leadership doesn't seem to be embracing the religious freedom project that King Abdullah did. So I'm wondering, is in the future, will that be something that will be embraced? How would that reflect economically on creating this attractive economic environment for global visitors?
Can we defer to Kristen? She's the only one who can really answer this. I can't answer that question very well.
There's not much I can say on that question, but if I go back to the economics, I link it to the number of visitors that are coming in to Saudi Arabia. The number of visitors have grown, not only in terms of pilgrims and Umrah and Hajj, but also the Saudi government is trying to actually increase the number of visitors that can come in, including by, for example, outside visitors can come in during a period close to the Hajj that has been much more reduced than before. So on the economic aspect, I can see that there's a lot of visitors coming. Some of the other aspects, I'll go to experts.
Maybe you want to link after we finish with Kristen, and so Karen, maybe this is a question you could answer. So it's what do you think of the kingdom using the renminbi and or rupees in oil sales and trade? Does it mean they're going to be looking to move beyond the US dollar?
No.
No. It's a one-word answer.
No one-word answer. It's just basic know your customer, and so yes, if you do a couple of deals in yuan, that's purely as a customer service relationship. It doesn't change the structure of the Saudi economy, of the currency tied to the U.S. dollar. I think those things are pretty intact.
Okay. I want to go actually on. We have like 5 minutes left. On China, so in your remarks, Karen, you mentioned about sort of opportunities and risks coming from China. One thing pointed out online, it's not really a question, but maybe I can turn it into a question, is China's exporting deflation. Is this a potentially positive spillover for the kingdom, given the need to construct huge projects in the coming years? What are your views on that?
Absolutely. I mean, Saudi Arabia stands to gain from kind of the current trends in some ways gain. Oil's a different story, but particularly in the move of Chinese solar manufacturing abroad, of increasing the general global consumption of some of these products, of EVs, so co-investments, and also traditionally still the petrochem space is still very good for both China and Saudi Arabia. So all the places where you see co-investments, there's a reason, right? I think they have captured that pretty successfully, the Saudi Arabia capturing both the opportunity and understanding to be kind of on both sides of the transition of the Chinese economy.
Okay, good. Maybe finish with a question for you, Amine, online. How reliable are the macroeconomic data and statistics coming out of Saudi Arabia today? Can you point to the areas where you've seen significant improvement in recent years, and any areas that still need work?
I think it's quite reliable and adequate for surveillance purposes that we have. We actually now have a new annex that is looking at data adequacy and looks at it from national accounts, balance of payments, prices, and fiscal. A lot has been done on on the GDP. Now we have a GDP on chain-weighted method. We're going to have a new household survey that's going to be exploited when you're going to have a new CPI. There's some work that needs to be done on having a producer price index and wholesale inflation to be there, and that's ongoing work. Also work to improve further external statistics and put a lot more of the information out there. And there's, on the fiscal, there's a lot that has been done, including in moving towards GFS statistics. But I raised one point earlier, I think, trying to produce that public sector balance sheet on the statistics will also be very good.
Okay, very good. Okay, I think I'll wrap it up there. Thank Karen and Amine for a great discussion. Maybe before we sign off, I'll just give one last plug to the IMF report, imf.org, Saudi Arabia country page. There is the Article 4 staff report. There's also the financial sector assessment this year, which I think are both, if you have any interest at all in Saudi economics, are both really good and important reads. Thank you for everybody who came in person attendance, and thank you to everybody who joined us online. Thank you.
Thank you. Thank you, Tim.